Revision 15. This one is all about the flow-on effect from decisions that you make when improving the risk profile of a business. So on the left-hand side, we have different risks that a business might face. In actual fact, used to fix. What we're going to do is look at the impact on the expense or the income and the income impact on the profit. So for you, you really got to think beyond the immediate impact and see how that impacts our business further on. So for example, if we decide to increase long-term loans by $50,000, what that will do is improve our risk because our bank account will go into positive. We'll be able to pay those accrued expenses and therefore reduce that risk. However, you need to be able to acknowledge that it's going to have an impact on the financial statements. And so that impact is going to be firstly to do with the interest expense. So we say buy first by increasing the loan by 50,000. Interest expense will increase, increasing total expenses. Therefore, flow on effect to profit. If we've got an increase in total expenses, it decreases the profit for the year, and then the name of the person, in this case, Ben. If we sell our delivery van for cash, so again, by selling the delivery van for cash, we've got money coming in, increasing bank, increasing our current and liquid assets, increasing that ratio, making that safe. But the problem with that is that we no longer have a delivery van. So by no longer having a delivery van, freight out costs will increase, therefore increasing total expenses. And if we increase total expenses, that is going to decrease the profit again for Ben. What about if we decide to sell the older inventory at a lower price? Quite a good strategy, this one. What's the impact on profit there? So really the impact by selling older inventory at a lower price, sales per item will decrease, so the sales price per item, decreasing our gross profit percentage. All right, because it's at a lower price, difference between sales price, cost price is lower. And if we decrease our gross profit percentage, that will decrease our profit for the year. If we cash in a term deposit, quite like this one. Remember yesterday's one we had Ben had a term deposit. Made really no sense for him to cash in to keep that term deposit. It should say buy at the front. So by cashing the term deposit, interest received will decrease, but we're not too concerned about that because the interest on his overdraft is likely to be higher than the interest on the term deposit. And so he's going to save himself a bit of money. So instead of decreasing profit, this will decreasing the interest expense more than it decreases the interest on that term deposit. So that will actually increase Ben's profit. However, you've got to realise that Ben obviously had that term deposit for a reason. He might have been saving up for something, and it may mean that he can no longer afford that. The owner cashes and puts 20,000 in, so it reduces the overdraft, reducing the total expense of that interest on overdraft, and therefore increasing profit. Again, that's probably our go-to, but you've got to realise that the owner doesn't necessarily like to invest more money, particularly in a business that's having problems. Think about that one a little bit more. We will get into level 2 on return on investment, which impacts this ratio as well. The last question is a liquid or current ratio of 6:1. Is that a good ratio? And I'm just suggesting here that it's not. Because by increasing the liquid or current ratio to 6:1, more money's on hand, and that money could be better used to do things like pay off loans, which have got a higher interest rate. So therefore, by maintaining such a high level of liquidity, you decrease profit because if you paid off the loans with that extra money, then what would happen is that you would less interest and therefore higher profit. You could also invest in property, plant and equipment that will increase sales. So having a high liquid ratio is not necessarily a good thing for the business. Great, enjoy the Kahoot.